constructive, interactive and beneficial to all of us. So let's begin with the session.
So let's start the session on transfer pricing in India. What are the contents we are going to cover here? So introduction, key concepts and definitions, and transfer pricing methods, transfer pricing documentation and compliance, and penalty for non-compliance, and some practical examples and common issues. First one is introduction. Question arises, what is transfer pricing? Transfer pricing is pricing of goods, services or intangible between associated enterprise. Here the objective is to ensure it is fair and market based. This line emphasizes the price must be arm's length price. Why it matters? Tax authorities are concerned that companies might set unfair prices and transfer the profit to the jurisdiction where there is lower tax rate. We shall understand this in upcoming slide with an example also. So this shifting of profit is called base erosion and profit shifting. And the arm's length price, this is the golden rule here. So it states that the price between the price quoted in a transaction between two associate enterprises must be same as there is a transaction between two non-associated enterprises. Transaction between associate enterprises and transaction between non-associated enterprises, both the prices quoted must be same. That will be an arm's length price. So arm's length price plays a vital role in the transfer pricing. What are the governing sections? Section 92, transaction must bear arm's length price, we have discussed in the previous slide. And section 92A to 92C, it defines what is an associate enterprises and what are international transactions and methods. Section 92D to 92E deal with documentation and audit requirements. Rule 10D is here. It specifies that some information and documentation must be kept for transfer pricing compliance. And in the first question only, transaction between two associated enterprises. So let's understand what is an associate enterprise. An enterprise is an associate enterprise of another if they have direct or indirect participation in management, control or capital. So to have an associate enterprise, there are certain conditions. By these conditions, we can say that an enterprise is an associate enterprise of another. First, enterprise holds shares with not less than 26% voting power in the other enterprise. Let's take an example. X Limited and Y Limited. X Limited is incorporated in India, Y Limited is incorporated outside India. And they both become associate enterprises if any one of these conditions are met. If X Limited holds shares in Y Limited not less than or equal to 26%, then these shall be associate enterprises. So the tax authorities have came to a conclusion that if there is not less than or equal to 26% shareholding, they can inflate prices, as they can do base erosion and profit shifting if 26% or more shares are there in another enterprise. And loan advanced by one enterprise to another contribute not less than 51% of book value of assets. Here in the 7 conditions, we shall take X Limited and Y Limited example, and I shall remind that X Limited is an incorporated entity in India and Y Limited is an entity incorporated outside India. Okay. Here X Limited has advanced loan to Y Limited, which is not less than 51% of the book value of the assets. Example, if X Limited assets is 1 crore, then advanced loan to Y Limited, which is not less than 51 lakh rupees, then these two entities shall be said as associated enterprise. Then guarantee provided by is not less than 10% of the overall borrowing of the another enterprise. Here Y Limited has taken a loan where X Limited has given guarantee. That guaranteed value is not less than 10% of overall value of the loan. Next, more than half of the board of directors is in one enterprise is appointed by another. Means X Limited can appoint more than half of the directors in Y Limited, or can appoint more than half of the directors or one executive director. One enterprise owns all IPR rights such as trademark, patent and know-how, drawings, related model and design and innovation, and other enterprises dependent on such enterprise for using these rights for manufacturing goods. So let's take an X and Y example, X Limited and Y Limited example. Here Y Limited is dependent on the X Limited for its manufacturing. Let's take example iPhone. If Y Limited is manufacturing iPhone, but trademark is with the X Limited, X Limited has given the permission to manufacture the Y Limited. If this condition is met, then we can say that X Limited and Y Limited both are associated enterprises. And if Y Limited's raw material, more than 90% of the raw material is procured from the X Limited, then we can say that both are associated enterprises. Then goods required by one enterprise are supplied by other enterprise, and prices conditions are also influenced by such other enterprise. Means here X Limited instructs Y Limited to manufacture some goods, and it also gives the raw materials, and X Limited only sets the price. So when an entity sends the goods and manufactures, and price also set by the entity which sends goods, then they both will become associated enterprise, or any other conditions. By these conditions, we can say that if any one of these conditions met, we can say that both are associated enterprise. For transfer pricing concept, if we make an equation like transfer pricing equation, two addition must be there. First one is associated enterprise, and another one is international transaction. If there is an associated enterprises and there is international transaction, that here transfer pricing concept will come. So what is an international transaction? So what constitutes a transaction? This includes tangible goods, services, intangible loans, and other financial transactions. If there is a transaction between resident and another entity which is also resident, then transfer pricing will not come, because there is no cross-border payments, or there is no concept of transfer pricing applies here. If there is any transaction between resident and non-resident, then transfer pricing concept applies, because there is an international transaction happening. If there is a transaction between a non-resident and another non-resident, then there is no transfer pricing concept applies. But if there is a transaction between non-resident and another non-resident only, but one non-resident has a place of business in India, then it shall become international transaction or not? It is a question. Like, I will repeat the question. There are two enterprises, both are non-resident, but one non-resident has a place of business in India. Then transaction between these two will become an international transaction or not? You cannot say the principle of place of business, but place of business is in India, then it shall conclude that the transaction are international transaction. So both will become a associate enterprise, and it will conclude for international transaction. As I said, I will explain upcoming slides. The transfer pricing refers to the pricing of goods, services, or intangibles between associated enterprises. Now we got to know what is an associated enterprises. So there is a transaction between these two enterprises, which are associated enterprises, and if they have set any price that is lesser than the arm's length price, so they are trying to make base erosion and profit shifting. Example, X and Y Limited. X Limited is in India. On X Limited has to pay tax at 30%. For example, US. The company is registered in the US. So both are associated enterprise. If US tax rate example is 10%. So what this company will do, X Limited will transfer the profits to the Y Limited, so that it will pay the lesser tax. So that's how base erosion and profit shifting happens. Now we have understood what is associated enterprise and what are international transactions. The equation is now met. So associated enterprise plus international transaction. Now transfer pricing concept applies, and the objective of the motto is to know that whether the transaction price is at arm's length price or not. So how we will calculate? There are methods. First method is comparable uncontrolled price method. So first we shall look at the definition, and we will see the example. Then we will come back to this definition and have an understanding. So this method compares the price charge in uncontrolled transaction to the price charge for a comparable transaction between unrelated party, that is uncontrolled transaction. This is used when there is a reliable data. So let's understand this by example. So X Limited and Y Limited. X Limited is an enterprise registered in India. Y Limited is an entity registered or incorporated outside India. And these both are associated enterprise by the conditions discussed previously. These two are associated enterprise. Now X Limited has sold goods to Y Limited, and at $4,000, if X same goods is sold to another foreign entity which is not an associated enterprise, means independent entity, then X Limited will sell at $6,000, but it has sold at $4,000. We cannot directly jump to the conclusion that there is a $2,000 inflated and it has shown less. This X Limited may say that this is our associated enterprise, so this Y Limited buys in bulk. We have given some discount also and warranty also. Then what we will, for arriving at the arm length price, what we will do it. So we will calculate uncontrolled price. Here we will not touch this value, this 4000 value, because this 4000 transaction value is between X limited and Y limited. So this is the transaction price between associate enterprise. These both can set any price. So the tax authorities do not trust this price. So what this method specifies is, take this value, sale. We will take and transaction with the any other independent entity which is not an associated enterprise. So in the $6,000 value, we will remove, if X limited specifies, we have given any discount, we will remove the discount also. For example, in $6,000, we will remove the discount of $600 and warranty 200. And if to selling to outsiders, if it has incurred any insurance and freight, then we will remove that also. Then $400. And we have come to a conclusion that arm length price is $4,800. But here, what X limited has done is, it has shown $4,000. So there is a difference of $800. Now, tax authorities, what they will do is, they have purposefully shown less. So basic base erosion profit shifting, they have shown less because they on 800 they were not willing to pay tax. So what tax authorities will do is, they will add back $800 to X limited income. So now it is at arm length price. So in the transfer pricing, we will not touch this value because this transaction price or value is between associated enterprise. We will add the $800 income to the X limited income. So this is the first method. Now we will go back to it. This method compares price charge in control transaction. What is a control transaction? The transaction between X limited and Y limited. That is $4,000. And we will compare with that transaction to the charge for a comparable transaction between unrelated parties. So here transaction between X limited and outsiders, $6,000. So we will compare and we will make the adjustments here like discount and all, and we will arrive at arm length price. If we compare the arm length price, we will not take this value 6,000 also. By using this, we will arrive at arm length price. Once we got the arm length price, we will compare with the transaction value between associated enterprise. Then we will come to the conclusion that whether the value quoted is at arm length price or not. If not, then if it is quoted less, then we will add back the income to the entity which has shown less. And in the transfer pricing concept, the tax authority's main focus is on this associated enterprise in India. We are not concerned on this. We are tax authorities are concerned on these enterprises, which is associated enterprise in India. In the upcoming methods also, this what I told, like India tax authorities focuses on this, plays an important role. So now we have got the idea of first method, what is comparable uncontrolled price method, and we have seen an example. Next method, resale price method. So this method is suitable where there is buying of finished goods and reselling it. So we shall look at the definition. This method starts with the price at which product is resold to an independent party. An appropriate gross profit is deducted to determine the arm length price. So it will be suitable where there is buying of finished goods and reselling it. And in the buying finished goods and reselling it, there is approximately same gross profit margin. Like if example, we will take an example of TV. If Samsung India buys from a TV from Samsung parent company is in Korea, so buys from a Korean parent company and resells it. Same if any other person, any other dealer buys it and he resells it. So gross profit is percentage is same. It is an assumption. So gross profit percentage is same. We will come to the definition after seeing this example. Here, Samsung India Limited and Samsung Foreign Limited, two enterprises. It is associated. These both are associated enterprises, and one is in India, another one is in foreign. So Samsung India has purchased, example TV, from Samsung Foreign Limited for $5,200 and resold it to any other independent entity at $6,000. Now, as I have mentioned previously, we will not consider this value. 5,200, we will not touch that. We will look into this value, $6,000. In $6,000, by considering this, we will calculate the arm length price. If Samsung India Limited says purchase related expense is $300 and normal gross profit percent is 20%. So this gross profit, assumption that it is same for all the dealers. Now, for ease of understanding, see, if sales is $6,000, so here we will taking this $6,000 and purchase related expense and GP percentage. If we look into this, sales is $6,000 and purchase related expense is 300 and GP percentage I have calculated sales 1,200. So we have arrived at the purchase value 4,500. What they have shown is 5,200. So if Samsung India says we have also received a discount, so then we will adjust that also. So we will adjust 200 discount. Then we have arrived at the arm length price, that is 4,300. Now actual arm length price is 4,300. But what Samsung India has shown 5,200. So there is a difference of $900 inflated value. So it has shown purchases at $5,200. Now what tax authorities will do? It will add back $900 to Samsung India Limited. So it is an inflated value. So arm length price 4,300. So $900 will be added back to the income of Samsung India Limited. So the calculations happens like this in resale price method. Now looking back to the definitions, this method starts with the price at which product is resold to an independent entity, that is $6,000 in the $6,000 here, and appropriate gross profit is deducted to arrive at the arm length price. So appropriate gross profit is 20% and we have also deducted purchase related expense and if any adjustment required. Third method is profit split method. As the method only specifies, what we are doing is splitting the profit split method. So this method says it splits the combined profit or loss of the associate enterprise in a transaction based on the relative value of the contribution. So here contribution plays an important role. How we are going to decide the value on their contribution. So when we will use it in where when transactions are highly integrated and difficult to evaluate them separately. So let's take an example. X Limited is an entity incorporated outside India and Y Limited and Z Limited. These both entities are registered in India. And X Limited has entered into a transaction to make a software for M Limited with M Limited, and in the procedure of making software it has taken Y Limited and Z Limited help for all together are making a software, because here Y Limited and Z Limited are associate enterprise of X Limited. So X, Y, Z, all three are working on making software for M Limited. And here X Limited are assigned on contribution. I have specifically told that focus is on contribution. So X Limited has contributed as in its share is X Limited has assigned its 2 engineers to this procedure of making software, and Y Limited has assigned its 4 engineers, Z Limited has assigned its 4 engineers. So we have got the ratio now, that is 2:4:4. And X Limited has earned profit of $1 lakh, and they have split profit among themselves with the $50,000, $20,000 and $30,000. Our focus is on whether this is a arm's length price or not. We will calculate by, in this method order will be, first we will split the profit, first we will calculate the profit, then split it, and we will add back the cost. We will come at arm's length price. So the total revenue is $1 lakh, and if cost incurred is $80,000 and total profit is $20,000. So we have arrived at the profit here. Next, we will split the profit in 2:4:4 because it has assigned 2 engineers, it has assigned 4, and respectively it has also 4. So we have got the ratio of 20%, 40% and 40. And first we will split the profit. 20,000 is split between these 3 entities, $4,000, $8,000 and $8,000 respectively. This cost is cost incurred by X Limited. We will adding back, we are adding back the cost, $42,000, $18,000 and $20,000. Now we have arrived at arm's length price. So $46,000, $26,000 and $28,000. Now we will compare this arm's length price with the prices quoted by the respective entities. Here X Limited has shown its value as $50,000. Are we going to consider this? Yes, that's the correct, because tax authorities are However, this has shown more. Like it is $46,000 and it has shown $50,000. But tax authorities are not concerned regarding this because it is an associated enterprise incorporated outside India. Tax authorities are concerned on this X Limited and Y Limited. Y Limited and Z Limited. So tax authorities are not concerned about X Limited. They are only concerned about Y Limited and Z Limited. However, in reporting, when Y Limited and Z Limited, when reporting comes, when we will see in upcoming slides, they will take this. They will take transaction with this also. But for the tax point of view, they are going to look into Y Limited and Z Limited. First, we will look Z Limited. So Z Limited arm length price is what? $28,000. What Y Limited has shown? $30,000. Now tax authorities are not going to question Z Limited. Now they will not ask for the arm length price and all. If arm length price is $28,000 and it is $30,000, now tax authorities will not question Z Limited. They will say that Z Limited's calculation is relatively correct. Now the focus is on Y Limited. Y Limited has shown 20,000 arm length price, but actual arm length price $26,000. Now tax authorities will look into matter of Y Limited. They will add back $6,000 in the income of Y Limited. So this is how the profit split method works. First we will take the profit, split it and add back the cost. We will come at arm length price and we will compare with the transaction prices quoted. So this method splits the combined profit or loss of an associate enterprise in a transaction based relative value on their contribution. So this is the definition. We have covered three methods now. Comparable uncontrolled price method, cup method, and resale method, and profit sharing. The fourth method is cost plus method. So this method, what this method states? This method determines arm length price by adding an appropriate markup to the cost incurred by the supplier. So ideally, when you will use this, will be used for manufacturers or service providers who add value to the raw material. Cost plus method. Here same X Limited and Y Limited both are associate enterprise. One incorporated outside India, another incorporated in India. If X Limited has sold goods to Y Limited, sale value is $4,000. And X Limited, if the same good is sold to any other foreign entity which is independent entity, it will be $6,000. Now, are we going to consider this 6,000 value? The question is, are we going to consider this value now? Yes. No, we will not consider this. If we will consider this, then it will become comparable uncontrolled price method, cup method. In cup method, what we are doing? We are doing the same. If we take consideration this, if we consider this and calculate like this only, then it will become comparable uncontrolled price method. We are not going to consider that 6,000 value. So sale of $6,000 is not considered now. Now, what tax authorities has specified in this method is take the cost of the X Limited, like what are your direct cost, indirect cost, and what is the normal GP percentage. Cost plus method in this method will be applicable where there is standardized gross profit percentage. Means comparable data is also available, but there is a standard gross profit percentage available with us, and we will make some adjustment. Example: if direct cost is $3,000 and indirect cost is $1,000, and gross profit percentage is 25%, so we will come to a value which is $5,000. If X Limited says that no, we have given some discount to Y Limited, which is our associate enterprise, we will minimize that also. If the example, if discount value is $500, then we will come at $4,500 value, but actual transaction value is $4,000. So, and our arm length price is $4,500. Now, tax authorities will add back that $500 to the income of X Limited. This cost plus method is used where there is competitive goods. Means, example, if there is any chemical company, and if many chemical companies have the same standardized gross profit, then cost plus method applies there. If you look back to the definition, this method determines arm length price by adding the appropriate markup, that is nothing but standardized gross profit, to the cost incurred by supplier. Next method is transactional net margin method, TNMM. What is this? This method compares the net profit margin to the tested party. one side of the transaction to the net profit margin of the comparable independent companies. So when we are going to use this, if other methods are difficult to apply and reliable data is also available, then we will apply transactional net margin method. So we will also understand this by an example also. Transaction net margin method and cost plus method both look similar. Both look similar. So what is the difference between transaction net margin method and cost plus method? Because the format is also same. So what difference can you identify in the transaction net margin method and cost plus method? Let's have a glance. What is the difference here? Yeah. The difference is here we consider net margin. So in the cost plus we are considering gross profit. In the net margin, transaction net margin method. So this method compares net profit. So we are taking net profit percentage, not the gross profit. If we take gross profit, then it will become cost plus profit. So we are going to consider net profit margin. It will be the same sum, but only where difference is here we will consider net profit margin, net profit percentage, and we will do the sum. If any value comes down to less than the arm's length price, so that will be added back to the income of X limited. Now we have discussed 5 methods, and the confusion arises which method to use. Like if we do like some confusion is regarding this transaction net margin method, cost plus method, and comparable uncontrolled pricing. So as I said, if there are any competitive goods and standardized gross profit percentage is there, then we will take cost plus method. And here in cost plus method, it is suitable for who add value to raw material. So when there is procuring of raw material and manufacturing happens, then cost plus method is applicable. Like in trading account also, manufacturers focus on gross profit. Service providers do not focus on the gross profit. Their focus is on net profit. So where it is there is no specific method, like it depends on the transaction. But if manufacturing is there, then we can consider cost plus method. But it also depends on the data available, business and the industry. We cannot directly jump to the conclusion you will use cost plus method, because in the transfer pricing report we have to justify why we have chosen this method. So when there is manufacturing, then we can take into consideration cost plus. When there is a service industry, so we can take a TNMM method, transaction net margin method. If the product is not competitive and there is no standardized gross profit or gross profit percentage, then we will take which method? Like my question is, if there is no standardized gross profit percentage and the goods is not competitive, it is basically unique, what method we shall consider? Yeah, we will take cup method. So now we have discussed which method to use now. Is there any specified method tax authorities has instructed to use? There is no specified method. Tax authorities has stated use the appropriate method. So what appropriate method you are using, what we are using during the transfer pricing, that depends on the business, industry and the data available. So we have to use the appropriate method and we have to justify that. So we have now we are looking into all the methods. We have arrived at the arm's length price, and we came to know how to calculate arm's length price and what are the methods. Now the question is why. So here proper documentation is crucial to defend your pricing during the tax audit. Failure to maintain document lead to penalty. And section 92D mandates maintenance of prescribed information in documents. So we have to specifically maintain transfer pricing documents. Like we have prepared the transfer pricing report, and we have information, and what information and what files we will look into after this. So transfer pricing documentation is very important, because if we have to defend our pricing. So what price we have put it is arm's length price. So there is no BEPS, there is no base erosion and profit shifting. So our pricing is same as arm's length price. So we have to justify that. So for that we have to maintain the documents. And if any failure to maintain documents then that will lead to penalties. Then, first in the governing sections, we have seen Rule 10D that some information and document must be maintained for tax for transfer pricing report. So this rule outlines the specific documents needed, including what is the legal ownership and organization structure, description of the business and industry, and during the method selection I also said it also depends on business and industry also, and economic and market analysis, selection of transfer pricing method and justification. So here we have to justify, like what if we have chosen a method, they have to justify it, and comparable data and financials. So if in case of cup method, the data must be reliable. So we should document that also, comparable data and financial analysis. Transfer pricing study report. So this transfer pricing study reports contains all the information. Transfer pricing study reports contains all the information required by Rule 10D and forms on the basis of company's transfer pricing policy. So this transfer pricing study reports has all the information, like what is the entity's name and which industry it is in, and what is the legal ownership. So what is required in Rule 10D, here it is there. So it is in transfer pricing study report. Forms to be filed in India. So Form 3 CEB, transfer pricing report. The purpose of the transfer pricing report is to report the international transaction and specify domestic transaction. This is mandatory for companies covered under Section 92E. So in transfer pricing report, we will specify what are the international transactions and who are the associate enterprises and international transactions. In Form 3CB, Form 3CAA, master file. Here, we will take the example of Samsung India Limited and Samsung Korea Limited. We will get an easy idea about what is master file, and there are three files to be maintained. One is local file, one is master file, and another one is this one, country by country report. First, we will take the Samsung India Limited and Samsung Korea Limited example. So Samsung parent company is in Korea. Its constituent company is in India. Now the Samsung India Limited has to maintain the documents of all its international transactions, where it will be information documents will be saved in local file. And tax authorities have also specified it has to maintain a separate file for overall overview of the multinational group's global operations. Means Samsung's overall global operations, they have to give an overview. So where that will be maintained in the master file. So in the master file, Samsung Korea Limited's global operations, a high level of overview is there. So Samsung India Limited must maintain the local file and also master file also. So for tax authorities, it gives an overview of the multinational group's global operations. So it will be applicable if group's total revenue exceeds 500 crore. Now another report comes country by country report. Now here one question is there. If Samsung India Limited is maintaining local file, if asked by the authorities, it will submit that, and master file also. Do you think Samsung India Limited must maintain country by country report? Like, first we will see what is country by country report. Purpose is to provide tax authorities with a holistic view of MNC's global operations, revenue and taxes paid. It is only applicable when there is group's total revenue exceeds 6,400. So if Samsung Korea Limited term exceeds 6,400, it has to maintain country by country report. Okay. Now Samsung India is maintaining local file also, master file also. Does it needs to maintain country by country report? My question is, Samsung Korea Limited is a parent company which is incorporated outside India. As now Samsung India is maintaining local file also, master file also. Now, do you think it needs to maintain country by country report? Actually, the Samsung India Limited does not need to strictly maintain the country by country report, because Samsung parent company is in Korea, so it is not an Indian origin company. So its parent company is outside India. It is not for Samsung India Limited not required to maintain country by country report, but tax authorities specify that like Samsung India Limited has to maintain country by country report. Then it has to maintain the country by country report. So this is the example where the parent company is in outside India. Now we will take an example. Parent company which is in India. Example Tata Enterprise. So in case of Tata Enterprise, it is an Indian company which is registered in India. It has it is a multinational. First of all, it is a multinational group. It has associated enterprise outside India. Now Tata Limited has to maintain local file also, master file also, then country by country reports also. This country by country report will be submitted by Tata Limited to tax authority. Then, if tax authority requires, like any other country, ask our tax authority to give this country by country report, then our tax authority will directly share this country by country report to that government. So, country by country report will be shared by our tax authority to any other government if required. Now, Tata Limited has to maintain all the documents, like master file also, local file also, then country by country report also. Filing deadlines for Form 3CB. So, due date. Form 3CB must be filed by 31st October of the assessment year as per section 92E. This deadline is critical for compliance and avoiding penalties. And due date for income tax return. The income tax return must be filed by applicable due date, which includes our pricing report also. This ensures that all the tax obligations are met within the stipulated time. So this is the deadline for Form 3CB, transfer pricing report. Now, penalty for non-compliance. As we have seen in transfer pricing reports and arrive at the arm's length price and what are the forms to be filed. Now, failure to furnish report. Like we have not furnished the report only. Penalty amount. Failure to furnish Form 3CB, transfer pricing report, will attract a penalty of 1 lakh rupees under section 271BA. This penalty can be levied per transaction also. It can accumulate significantly. Practical implication. Non-compliance means non-filing of Form 3CB can lead to increased scrutiny, audits and potential litigation affecting the taxpayer's reputation and financial stability. Incorrect information. Now here we have not furnished the information before. Here incorrect documentation. So there is an entity, for example X Limited and Y Limited example. X Limited has given incorrect information or incomplete transfer pricing documentation. It attracts a penalty under 271AA, 2% of value of the international transaction. How penalty is calculated means, if incorrect or incomplete transfer pricing documentation is given under 271AA, penalty will be 2% of value of the international transaction. So this penalty can be substantial, means this penalty can be huge when there is large international transaction. Just 2% of the value of the international transaction. If the transaction value of the international transactions are high, then this penalty can be huge, substantial for large transaction, emphasizing accurate and comprehensive documentation. Failure to furnish information, penalty for non-disclosure. So here also under section 271G, penalty, failure to provide required information to tax authorities under 271G attracts a penalty up to 2% on the value of international transaction. So in 271AA to 271G, penalty is still 2% on the value of the international transaction. But for incorrect documentation, 271AA. Failure to furnish information, 271G. Practical examples and common issues. Observe. If, example, service provision, an Indian subsidiary is providing service to its US parent company. The price quoted by Indian service company to its parent entity must be at arm's length. It cannot be, we have seen in the methods explanation, it cannot be lesser than the arm's length. And in case of intra-group loans, the interest rate shall be comparable with the commercial loan rate. Common mistakes and audit risk. What is the common mistake? Poor documentation. Not maintaining a transfer TP study report as per Rule 10B. So, an entity must maintain transfer pricing study report. And mistake 2 is using inappropriate method. Here is a solid example, like Samsung India Limited and Samsung Korea Limited. Samsung India Limited has purchased goods from Samsung Korea Limited and resold it at $6,000 as we have seen in the previous slides. Now, while we are doing the transfer pricing report, we have taken cost plus method. Is it appropriate method? There is a buying of finished goods and reselling goods. So the appropriate method here would be resale price method. Now we have taken cost plus method. So here we have to give justification. Now we cannot justify here. There is a buying of finished goods and reselling it. So appropriate method would be resale price method. There is a problem in justification now. So choosing a transfer pricing method without a proper justification can become a huge risk. Weak comparables. So using the data of companies that are not truly comparable to tested party means we will take standardized gross profit percentage and all. While comparing, we have taken an entity. Means in comparison, their comparison is between people who are equal. We are taking a data of one company which has a very good reputation and one startup, and we are comparing them. That is not actually a good comparison. So that is nothing but weak comparable. Now we shall see a standard transfer pricing study report. Transfer pricing study report. So what are the contents? We will give summary, background. Here it is a table of contents. Now we shall give the background. So ABC Private Limited, and we will give the summary of the international transactions. What are the summary of the international transaction we will give here. Next we will have corporate background. Like if any entity has changed its name and we will going to put this previous name and the year in which the name got changed, and if there is any changes in the profit what you can say share capital, we will mention that also here. And we shall give the examples by we shall give what are the products of the associate enterprises. First we shall give the information regarding the products, what are its products and all. Next, analysis of the transaction. So what are the transactions entered by associate enterprise, what is the amount, we will give them. After providing this data, then we will have an industrial overview. So during the choosing of the transfer pricing method, I have said that it depends on the industry, business and all. So we will give an industry overview. Industry overview means entity is in which business. So then we will also get the comparable data also. So in industry overall overview, here we have given key factors. What are the key detailed report? What are the key factors considered here? Plans and plans are given here, and we will do function and we will give regarding functional analysis. What functions the entity has performed here, like strategic management, corporate services, and research and development, inventory management, pricing, distribution channels. After giving this, we will give economic analysis. So during the COVID pandemic, automobile industry has been affected more. So we will give economic analysis. So what is the economy during that year, or what is the economic situation of the country in which associate enterprise is registered. So we will give an economic analysis. Selection of most appropriate method. So here focus is on. So I shall read the slides. Net profit, net margin earned by comparable companies performing activities similar to those of ABC India Limited are available in the public domain and can be easily established, thus facilitating a more reliable comparability analysis. So in this report we have to give all the five methods, and we should state that why this method is not appropriate. Like why we cannot use cup method, why we cannot use resale price method, why profit sharing method is not applicable. So first we have to give method, what is the method and why it is not appropriate here. See here. So it is well accepted principle, net margins are less affected in case of transaction differences that are prices in case of cup. So cup method, choosing cup method here would be in not appropriate method. Then and gross margins in case of resale price method and cost plus method. So they are telling that choosing cup method and RPM method or cost plus method would be inappropriate. So in this, since the functions performed by comparables identified by us
were broadly similar to be functions performed by ABC India, the transactional net margin method, which involves net margin comparison, was considered as most appropriate method for testing above the transactions of ABC. So they have chosen transaction net margin method. So we have to justify. First we will give all 5 methods and we will state why this method is not an appropriate method to select. Then we will select what is the method we have selected, PNLL. This is the most appropriate method, testing the above mentioned transaction of ABC Limited. So it is depending on the industry and the business and the data transaction of ABC Limited. And we shall give about what are the margin of computation and all, and computation of margin, transfer pricing methods. In this we have explained what is the transfer pricing method and compliance and non-compliance, penalty for non-compliance and what are the documents you should make. Thank you.